The chapter starts an empirical evidence on the security return. Everything mainly revolves around testing the CAPM and the emergence of multi-factors models and consumption-based models. And since most of this content Professor has delivered in the class, we were just particularly interested in the consumptions, the CAPM. And as this model leads to one of the biggest questions in the modern finance, the equity premium puzzle. Traditional CAPM assumes that investors care mainly about growing the wealth and measures risk through market fluctuations. But hold on. What's the point of holding onto a lot of cash or stocks not to spend it? Buy a house, a car, and provide for your family for the rest of your life? CAPM argues that wealth is the only means to an end, and what investors ultimately care about is consumption. So, an asset is valuable because it helps maintain future consumptions and a stable standard of living. CAPM doesn't care how stocks fluctuate with the market. It uses consumption beta, measures whether stock yields move in the same direction as or against with the aggregate consumption. As in the formula, A is risk aversion and the other is covariance between market returns and consumption. So if this covariance is positive and very large, it means that when social consumption decreases in the crisis, the stock price also falls sharply. And this stock won't help your life in difficult times at all. It's too risky and people will demand a very high risk premium before they even consider buying it.
Now here's where the puzzle begins. According to the consumption CAPM, stock return should depend on the consumption risk. But there's one problem. Consumption is actually quite stable. Even during recession, people still need to eat, pay rent, and buy basic necessities. Consumption goes down, but not by much. So the model predicts that the equity premium should be very small, maybe around 0.1% or 1%. But reality says otherwise. Historically, stocks have beaten government bonds by about 6% to 7% per year. That's a huge gap. To explain it, the model has to assume that investors are extremely risk averse. Basically, it assumes people are terrified of risk. But let's be honest, we don't look that scared. And yes, the market keeps rewarding stock investors with very high returns. That contradiction is what we call the equity premium puzzle.
There are four possible explanations. The first one, consumption risk is real. Stock price decreased precisely at the same time that consumption decreased during the economic downturns. Investors are double suffer and painful. Of course, they ask for higher return. The second one, the high return in the history is actually unexpected, not because investors were to hate risk and asked for high return. Well, in 1950, they even entered the market with a very normal mindset. They didn't demand for the sky-high returns, which means A was not too high, they were just too lucky. And the US economy subsequently boomed beyond the expectations, and the stock was just soaring. Third one, the returns look unusually high because we are focusing on the US. This is great survivor. This is called survivorship bias. Once we include countries that were hit hard by the wars and economic disasters, like Japan or Germany, the equity premium becomes much smaller and more consistent with the theoretical models. Fourth one, according to the Constantine explanation, equity returns are high because investors fear the devastating combinations of losing both their jobs and their investment during the economic downturns. And what's more, well, younger investors who are more of a risk taker often face borrowing constraints. On the other hand, wealthier investors who are often the older, more risk averse, more conservative, they just want to be safe, ask for more compensation for bearing the risk, and that is the high return reflected by the market. In conclusion, in investment finance, sometimes decisions are influenced by human psychology and emotions, but traditional models just simplify human behavior too much, and that is why equity premium puzzle arises. And to the true spirit of CAPM, maybe the terrifying is not losing money, but losing money precisely when you need to spend it. So, thank you for watching and see you again.